We'll cover the market, we'll cover the economy, and we'll give you an outlook from our research partners. And it's just a blessing to have you all here. You know, we work with a small number of successful families, and we help provide an income for you that you will not outlive over the duration of your lives. And if you know somebody who has questions about that in this very uncertain world with a very uncertain, volatile future, please make an introduction. One easy way to do that is just scan this barcode, and you can send that link to a friend of yours, and they can schedule an appointment with us right online. Very good. I'll put this slide or one like it at the end of today's presentation. I'm going to read through the slides here. Like the Denver Broncos, I come in with a script. Hopefully my first quarter is a lot better than the Denver Broncos. U.S. stocks continue to climb the wall worry in the third quarter, gaining over 8%. Returns continue to be driven by stocks in the tech sector, lifted by optimism around AI investment themes. The rally extended to small cap stocks, which ended the quarter up over 12%, amid hopes that lower interest rates would benefit small companies. International stocks continued the run of solid performance for the year, rising nearly 5% in Q3, lifting its year-to-date returns to 25%. Yeah, wow is right. Emerging market stocks were the standout performer in Q3, not to be undone by the developed international companies. They rose 10.6% in the quarter, bringing their year-to-date total to over 27%. Gains in the quarter were driven by easing global financial conditions and attractive valuations. Year-to-date, developed international and emerging market stocks are still outperforming U.S. stocks thanks to a roughly 10% decline in the dollar. We'll talk more about that in some detail here soon. In the U.S. fixed income market, after holding rates steady for the first 8 months of the year, the Federal Reserve returned to rate cuts in September. Against this backdrop, investment-grade core bonds finished the quarter up 2%, and high-yield bonds were up 2.4%. And on the year-to-date basis, investment-grade bonds are positive 6.1%, and high-yield bonds are positive 7.1%. What a remarkable quarter to an above-average year. Truly remarkable. In the last category here on the right, you'll see managed futures are still down year to date, but they're only down 2%. I'll talk more about that. You might have some of those in your portfolio, but they would not be a very big percentage of your portfolio. They also had a remarkable year, or a remarkable quarter, up 8.5%. Let's talk a little bit about the economy. I mean, if that's it, right, that's the end of the show. That was a great first quarter, a little bit better than the Broncos. We can just skip to the end of the year and be happy with those returns, right? I wish we could. I wish we could. We do see a lot of volatility ahead of us. And the good news is you've already ridden through a lot of volatility, whether you paid attention or not to the big decline we had intra-year on our way to delivering this above average year return in almost every single thing you're invested in. You may see more volatility in the future. And so I'm going to encourage you to hang in there and turn off CNBC and instead call your advisor. Let's look at inflation. Inflation's real and normal. The Fed is balancing inflation risk alongside economic slowing growth. The Federal Reserve reinitiated rate cuts in September, bringing its target rate to between 4% and 4.25%. The Fed will meet next week. At the time of recording, it is forecasted that they will drop it another 0.25% and another 0.25% before the end of the year. This was the first rate cut of the year in September. The Fed previously eased 3 times from September to December of 2024, and that was 100 basis points of cuts. If you don't remember, it was only a year ago when they last did this. Then the Fed paused over concerns of inflation. It remained stubbornly elevated above 2%, and indeed, it's still above 2%. If you look at both of those numbers, see it's in the 3% range, but it's moderated. So moderated inflation gave the Fed room to cut rates. 2 more cuts are projected by the end of the year. And that huge spike you see is COVID. That's not exactly something we could forecast. Next thing on the Fed's worry list is unemployment. And the labor market data indicates the economy is slowing. So the Fed's recent decision to cut was positioned by Fed Chair Powell as, quote, risk management, end quote. It's a steep, given big concerns that they have over the softening labor market and slowing economic growth. But again, you can see that the unemployment rate over this long period of history back to 1948, during our lifetimes, were about average. It's not a significant unemployment rate like we had during the COVID crash, that huge spike right there. And looking ahead, the Fed is leaving the door open for additional cuts, but Powell has been careful to emphasize that further easing will be data dependent with the goal of balancing the risk of higher inflation with supporting growth, which is our best efforts to interpret the opaque language of the Federal Reserve. More or less, they do tell us what they're going to do, however, and that's been something that has driven market commentators crazy because they have nothing to prognosticate about. The Fed is projecting what they're doing, and they're doing what they're saying. And it looks like another quarter cut is happening next week, perhaps, and maybe another one the week after, the months after that, before the end of the year. And all that boosts the economy. And they believe they can do that because they're a little worried about unemployment stepping up a little bit right here. Nothing like what we've lived through. Nothing like the great financial crisis. Nothing like the early 1980s when interest rates were driven upward by Paul Volcker, the stagflation of the 1970s. Nothing along those lines. Just modest unemployment increases, which gives the Fed an excuse to lower rates and boost the economy. So here's the Federal Reserve, and the Fed cuts rates in September. 2 more cuts projected by the year end. Looks like this. This is what it looked like in the past. What I and Global Partners, our research partner, is doing in this chart is showing you the big gray bars are recessions. And what they're showing you is that when the real inflation adjusted rate that the Fed sets their rates to is too high, in fact, and Global Partner says when it's in prior cycles, levels of 3.5% or higher, historically proven too restrictive, ultimately choking off growth and leading to recession as the Fed waits too long to ease the rates. And we're nowhere near that, says I&I Global Partners. In fact, today, I&I Global thinks this level of real Fed funds rate, needed to cool an overheated economy is lower than in past cycles. So we don't need to get that high to cool the economy, given the lower trend growth relative to history. And so they think there's plenty of room to lower it, even from here, giving more growth to the economy. And so if this chart doesn't make sense, we'll come back to it later. It's effectively saying, what's the rate minus what's the inflation rate? And that's the real rate. And when it's too high, it's too restrictive. And when it's low, like it is now, or average, if you took an average across all those years, all the way back to 1962, you'd see that it's not restrictive and it doesn't portend a recession up ahead of us. I'm going to give you 5 reasons why the U.S. market, 5 slides, why the U.S. stock market is not something for you to worry about. I'm going to make that case. And then I'm going to remind you how I started out this presentation by saying we're going to have higher volatility. And so I want you to talk to your advisor during these periods of volatility that are ahead of us and turn off the CNBC. One of the things you will hear from commentators out there will be equity valuations are too high. And indeed, if you look back over the past 25 years, a commentator who I trust dearly, who's been in the industry since 1967, Nick Murray, he's a guest columnist on our Periscope every week. If you're not getting it, please tell your advisor and let's make sure you do. He calls the past 25 years a laboratory because we've had 7 stock market crashes of greater than 20% in the past 25 years. And yet the market has shot upwards over those years. What you're looking at here is the price of the equities divided by the earnings that the equities are earning over those years. And on average, the past 25 years, we've been willing to pay a higher price. And that portends higher volatility perhaps ahead of us. I'm going to give you 5 slides here that tell you that that's not what we need to worry about. With U.S. stocks near all-time highs, and they are, current price levels raise the question of valuations. Are we paying too much for these stocks? Have they overshot? There's a rule in the stock market that anything that's worth doing is worth overdoing. And so people are worried. Are stocks overpriced? Are we going to have a big crash? At present, the S&P 500 trades at 26 times the trailing 12-month earnings, compared to a long-term average of 17.8. That's what that dotted line is there. And so it seems at first blush like, yeah, we're willing to pay too much. We're willing to pay $26 to get $1 of return earnings on your portfolio. These levels are not lost on I&I Global Partners. They remain a critical factor they monitor closely, yet context matters. As you can see in this chart, U.S. stocks have traded above its long-term average for almost that entire duration. The only time it didn't was during the great financial crisis. And so they can remain up there a long time. During the past 25 years, you have had in your portfolio significantly more money than you ever had before that. This is the most important time in your life to be an investor. And the equity valuations have stayed high, and the market has rallied tremendously since the year 2000. An immense growth, something along the lines of 16 or 17% annualized over that period of time. So equity valuations themselves are not the problem. Companies are profitable. That's another reason to not worry about it. Again, highlighted on the right-hand side for the past 12 years, a higher fair market multiple is warranted given the structural changes in the economy and the index composition over the past 25 years. Different types of companies are getting bigger. Higher quality companies with bigger earnings that are growing faster. Shift away from capital intensive, think manufacturing companies, the shift in our economy away from manufacturing into asset light businesses, like software companies and technology companies. They have stronger balance sheets, resulted in more resilient profit margins. They continue to make money. They don't have to worry about manufacturing. So the chart shows, it says the mid-1990s margins have increased. Look at the margins here. During the past 25 years, if you go back to 2001, margins were between 2 and 3% at their bottom there. But even if you averaged right below that at 5%, now we're looking at margins between 10 and 12%. They've more than doubled. In fact, they've really doubled since the 90s, since the dot-com, which we'll talk about here soon, because people think that we might be entering another dot-com bubble, but they're more profitable than they've ever been. And they've been able to withstand this higher multiple. You're willing to pay more because they're higher quality companies. Technology companies are increasingly a bigger part of our portfolios. Tech companies now comprise a larger percentage of the S&P 500 than they ever have before. Today's economy looks different than in past decades. Historically, these capital-intensive companies, these manufacturing companies with lower margins and higher reinvestment needs, dominated the market. Look at the chart on the left-hand side. In 1980, 66% of the companies out there were in manufacturing. Now, as shown on the chart, technology and service-oriented companies, which scale efficiently, require less capital, and have higher margins, represent a much larger share of the S&P 500. Today, roughly half of the index is represented by innovation-driven companies. While manufacturing has shrunk below 20%. Naturally, investors should apply different multiples to cyclical, capital-intensive firms on the old days versus these high-margin, scalable businesses on the right. And if you look at this, what I found really interesting about this is that for the past 10 years or so, you can see the orange bar, or the gold bar, growing from a 33% to 49%. That's the innovation sector growing to half of our portfolio since 2014. But the 20 years prior to that, the 10 years prior to that, really it was, for that 20-year period of time, it was about a third. And then there's another 20-year period prior to that that says, oh, okay, manufacturing was still about a fifth, or innovation was still about a fifth. But from the early 80s and before that, it was nothing around, right? Thank you, Bill Gates. Thank you for the innovation of the personal laptop. Thank you for Excel, really. I mean, the Excel bump here, Microsoft Excel, in and of itself can be one of the greatest inventions of all time. These are the things that are changing the market over the big period of time. We're in another bubble like that. We're in a period of time that could last. A 20-year bubble could be not even the beginning of what the market could look like. This could be a trend where asset-like companies continue to grow and grow and grow, and the other companies shrink and shrink and shrink as a percentage of the GDP. Another reason not to worry about the S&P 500 and the valuations and the news that people talk about is the rise of passive investments. The rise of passive investing has distorted the market value. So what passive investing is doing in the S&P 500 with your 401k and everybody working, a bigger percentage of Americans right now have money in the equity markets than they've ever had before. And they're just allocating in their 401k every 2 weeks or whenever they get their paycheck. And the money goes in, and it just sits there. And this is really, really healthy behavior for Americans to be doing that. And the money continues to grow and continues to grow. And what this chart is showing that in 2023, there's more money allocated that way, in a passive way, than there is in active investing. And so that's just naturally buying the companies that are bigger. And so the bigger companies are getting bigger with the bigger passive investments going out there. And beyond the structural changes to the economy and the composition of the S&P 500, structural shifts in market dynamics change the way that we invest. The rise of passive investing has fundamentally altered flows into equities. defined contribution plans, these are the 401ks and other retirement plans from work and the government. Replacing defined benefit pensions, which we haven't had since the 80s when people would receive a guaranteed income from an employer. They just throw the money into the market regardless of the valuation, and that smooths things out. Morningstar data shows that as of late 2023, they overtook. So that's the source here for Morningstar data. So these are the slides that I wanted to show you, with the final one saying, but going back to the price and earnings of the companies we're paying. And so now we're entering a period of time. It might be the most complicated chart, but it's the one that I want you to spend a few seconds and look on, because we're in this kind of a gray bar on the right. And what we're saying is the amount of money that we're spending for companies, the price, the amount of earnings that we're getting is really high, right? It's around 27. That's what we're talking about. And now we're looking forward and saying, well, they're forecast to make even more money. So we're saying, the market is saying, based on the forecast, we're paying $22 for every earning they're going to receive. So their future earnings look great. And during that period of time, how have the returns been? They've been really high. That would be on the top part of the chart. Or they've been really low. That would be the bottom part of the chart. You can see most of the dots, every single dot is a year since the start of the U.S. stock market. Most of the dots are way on the left, that during most of this period of time, looked at those charts and said, since 1980, before 1980 it was all manufacturing. Since then, it's been growing and growing technology, and the prices are getting higher and higher and higher. Well, those returns are really good. You're going to see about 7 dots below the line, and you're going to see more than 10 or 12 higher than the line, and the amount that they're higher are better than the amounts that are lower. So there's a big standard deviation. There's a big deviation here. We're going to have some short-term volatility, but the averages are going to be above average. If history is any guide, it's the only guide we have. And this is why I'm saying that we're entering a period of higher volatility. We already lived through that this year. We already had, if you didn't pay attention, a 20% decline in the market during March. From about February 18th until about April 8th, market declined intraday about 20%. In fact, I think during the day it might have hit even a 21. Then it rallied back on the bottom of April 18th, and you're giving you those really high returns that you've seen this year, over 10%, and just about everything I put up on the slide at the beginning of our presentation. And that type of volatility could be continuing, because we're in this type of a situation where when you're going in with high prices, you still have a chance to make really good returns. In fact, above average rates of return, there's more chance of better returns than there are losses, but the bounciness around that is going to be big. So that's why you're going to want to have that person to talk to and say, well, what do we do? How am I okay? How are we going to make it through this? Over a 1-year period of time, other factors than valuation make a bigger difference, not the price you're paying going into it. Other factors such as earning growth, monetary policy, the Fed, and investor sentiment play a much larger role than the price of the stocks going in. That's the key message here. It's back to the fundamentals, and you want to have good, profitable companies. You're not invested in the stock market, you're invested in individual companies. They're individually going to make money, and they're going to go through whatever, they're going to survive whatever the market is throwing at them. Does that make sense? Those are the 5 points that I'm making about the U.S. market, that yes, we're likely to have more volatility, but yes, the returns are likely to be above average, continuing going forward. And it's going to be an interesting time. We're feeling so much stress and pressure from geopolitics all the time. We're feeling social pressures from social changes that are going on in our country. And we're feeling these threats of war from all around the world, and all sorts of things, and maybe in our personal lives, right? Health issues and other things that are going on. These are things that are adding to the stress. Don't add to your stress unnecessarily. Don't look at the market and think you need to act on what's happening today to make your life better or to make your retirement more secure. This will only add to your stress, because there's no way we could know that the market would decline like it did before Trump announced the Liberation Day tariffs, and that 6 days after he announced it, the market would rally back well before Trump pulled back from the tariffs. It was always going to happen before, and it will continue to happen that way. The market will anticipate, and anything that can be done will be overdone by the markets. That's one of the iron laws of equity investing. The other thing is, if you're one of our clients, then you have a lot of money that's not in the U.S., and that doesn't matter to you. And what you're finding in international is you're getting much better deals. So on the left-hand side, you'll see the U.S. forward-looking earnings, and that's at the 22 or 23, and that's pretty expensive. But look at how inexpensive it is to invest internationally, whether it's in developed countries or emerging markets. Developed international and emerging market stock have outperformed the US year to date, and their valuations are still cheap year to date relative to the US. We remain diversified with strategic equity allocations across the US, across the developed countries in the world, and across the emerging markets of the world. We don't know, but we don't completely depend upon the geopolitics. The next slide is one I've shown for years, and it shows you the relationship between the dollar strengthening and the dollar weakening. At the beginning, I said the US dollar is down about 10%. This slide ends at 2023. It doesn't show 2024 or 2025, and the dollar's down since then. But when the dollar is declining, that's the line going from top left to bottom right at the beginning here. You can see international equities shoot up a lot. In that first section from 71 to 78, non-US stocks rose 179%. And then the dollar started to strengthen. And this was the Reagan years when the interest rates were shooting through the roof. And it was a very hard period of time when interest rates got so high. But the US dollar strengthened radically. And by the end of that period of time, by 1985, US stocks had risen 169 and non-US stocks still rose 60%. So it's still good. And you can see that trend continues. Well, we may be entering a period of time where that's changed because over the past year it has changed. The dollar has declined and international equities have outperformed by a lot, doubling up, more than doubling up the returns of the US at the time of speaking. So that's a good time to be a diverse and international investor. Diversification works. It benefited our portfolios this year. Portfolios benefited from global diversification despite a very volatile half of the year. Look at the bars, and those should be very similar to the bars we saw at the beginning of the slide. Intermediate bonds are 6.1, high yield bonds are 7.1. The US S&P was 14.8, a well above average year. Developed international 25 and emerging markets 27, and the dollar down 9 or 10% year to date. But look at the dots, and you'll see their maximum drawdown during this year. And this is what you survived by not acting on it. You earned those gold bars by not panicking when bonds were down 2.5 or 3.5, when the equity markets were down 18.9 and intraday 21, when international was down 15 and down 12. You're getting those big outsized returns by ignoring it. And that trend is what I think is going to continue. I think we're going to have those blue dots be big downs for short periods of time because we're entering this period for no other reason than we've got high valuations, and you saw the scatter plot a while ago. So fixed income generated solid returns. Importantly, fixed income on the left-hand side provided stability. And so that can be something you can talk to your financial planner around if you want that in your portfolio. I don't want to talk about the loser year to date. Managed futures. Managed futures for a lot of our clients is a very small portion of your portfolio. You might have 5 cents of a dollar in this asset class. Year to date, I think through the end of September at the beginning slide, it was down 2.5%. Despite rallying back big, it was down further in the beginning of the year. But look at how this little slice of your portfolio does when we do have big financial crises. In October 7th to February 9th, it was the great financial crisis. We didn't know the world was coming to an end. Everybody thought that Lehman Brothers would stay in business, and then all of a sudden it wasn't. All of a sudden, Merrill Lynch had to take over, or Merrill Lynch was going bankrupt and had to be bought by Bank of America, and all these other companies started falling apart, and we didn't know what was going on in the world. And equity markets freaked out, temporarily got really emotional, and the companies that we were invested in still had profits, but their share prices declined by more than half. And during that crazy period of time from which we have rallied back tremendously and will continue to do in the future, managed futures did really well. It would have helped to have a little bit in there that had a gain. The next period of time was COVID, which was an even more terrifying crisis from my point of view than the great financial crisis because it was at our health. It threatened our lives. It would end up costing lives of millions of people around the world. And during that period of time, equity markets declined 13%, but managed futures held their own, and bonds also declined in that period of time. So that was the beginning of a hint that maybe bonds are not all they're cracked up to be. And certainly at the end of COVID, when our government raised interest rates tremendously, crazy, faster than they even did during the vocal years of the 80s, equities declined, managed futures shot through the roof, and bonds also declined. So you can see why the big loser this year, which is a really small, maybe nickel to 8 cents of every dollar that you have invested, can be really good in times of crisis. And so that's why we're holding on to them. Ask your financial planner how much you might have in there, if it's of interest to you. It's a diversifier. All right, so let's look at the fixed income. One of the things that's passed around, and we had this great chart come through our office at the beginning of this week, and it said, "Oh, people are now worried about private debt. They're worried about all of these companies that are holding too much debt, and interest rates are too high, and they're going to crash, and they're going to crash the market." Indeed, there have been some really bad investments lately that have crashed, and they're worried about banks going under. Well, the truth is, across the market, things are pretty good. The average, the credit spread, is the amount of risk that companies have. So if you're a high risk company, you have to pay a higher interest rate on your loan, on the money that you borrow. And if you're a low risk company, you pay a very low interest rate. And the average amount of risk is 4.7, and we're currently at 2.5, meaning that even a high risk company is only paying 2.5% more than a low risk company today. And usually they have to pay 4.7%. So usually it's almost twice as risky as it is today. In other words, companies are coming into this higher earnings environment with less debt and better able to cover it. And the Federal Reserve is lowering interest rates over the next however many months, 3 months, I guess, of the year. Well, this is a good time, right? This is not the worry, right? That's not the worry that our equity team, our investment team has. Credit spreads are low. Credit markets remain strong. Investment grade and high spread yields are tightening, destroying strong corporate fundamentals and demand. I.M. Global Partner continues to like bonds. Over the past several years, many companies have delivered extended maturities, improved balance sheet quality, leaving them in a strong position to withstand high rates and slower economic growth. That's a whole bunch of fancy words to say next. Not worried about that. In fact, I mean, bonds are looking good. So these are some of the funds that many of you have that we have money invested with, and these are their current yields, and those are not small. So if you bought it today and you held on to it for a year, that's the yield you would currently be expected to receive. And so these are some of the funds, and you can see the higher ones on the right are the ones that are generally a little bit higher risk, and the ones super safe on the left, but you're earning somewhere in that range, and their total returns year to date are between 6 and 7. That's pretty good, like above average good. This is better than it has been recently. The final slide, the final economic slide, I might go through a little bit too fast. But what this chart is going through is saying that what drives all of us right now is the amount of money that we have. When I started my career in the 90s, I was born in 73. I'm 52 years old. We had financial crises on the year I was born. We had financial crises when I started in the industry. A few years after I came into the industry, we had the dot-com crash, which still to this day is the biggest percentage decline we've had. The Great Financial Crisis was by far the most terrifying, and it happened just a few years after that. A few years after the Great Financial Crisis, we had another crisis that you might not even remember, but I remember really clearly because so many of you were so terrified about, and I was too, because we'd never seen it before, Europe, Southern European countries bringing down the entire world. We just came through the financial crisis in 2011. It's the debt crisis of European countries going to bring down the whole world. And a few years later, there was another crisis, and then we had COVID. And then we had the first Trump administration, about this time of year, also shut down the government. We had a Christmas Eve tantrum. I don't remember this, but the market usually rallies. And in 2018, the market declined pretty big and then rallied back really quickly. And so we've been through all these crises. The one that scared our equity managers the most was the amount of money that was printed after and during COVID. And that's the big spike you see here. So without understanding how the math is done on the left-hand side, it's drawing a line over a long period of time, since 1959, about how much money is in the world and how much demand there is for it. And the big spike here is the COVID year, and it says everybody was scared of everything, and everybody just wanted to hold on to money, and it wasn't going to move around the world. And when that happens, the market crashes. And we're right in balance. Market is saying that's not the problem that we had before. The overprinting of money is a problem that all of the people that we were following were saying, this is a big problem. We're printing too much money. It's too much money. It's going to cause inflation. And it did. Inflation spiked to 9% during that period of time. And for the past 10 years, the average cost of a good in America is 36% more expensive than it was 10 years ago, with some things bouncing around about 20% per per day. The price of gas at the gas pump rose 20% overnight, and might drop 20% tomorrow night. Right? It's still cheaper than it was 3 months a year or to a year ago. Things are bouncing around. The volatility is strong, but this tells us that the amount of money in the market is not our problem. That inflation is not a given based off the amount of money that's out there. That it could be that we walked that rope, that we printed all of this money that's been consumed, that you have more money in your retirement accounts, and you have less concern or less reason for concern than you did during the COVID crisis for things falling apart. That people are not terrified about that. So A&I Global's current view is that the structural forces that have historically driven inflation in the U.S., the balance between the amount of money out there and the amount of demand for it, are in equilibrium. These structural forces that they refer to as gusts of wind in the inflation landscape tend to dictate the broader direction of, and persistence of inflation, and since the post-pandemic period of imbalance, which was terrifying. That this chart, if we had drawn it from, I don't know, 10 years prior, you would have seen it tripling, right? This is a huge, huge growth. Since the post-pandemic period of imbalance, both the supply of money and demand for money have normalized, contributing to overall disinflationary powers that are out there right now. That many people thought, with the amount of money, the tripling of the cash in the U.S., all the cash in the U.S., that we've had worse inflation than the 9% we had for a year right after COVID, is no longer a problem. That it's been gobbled up. Maybe it's all going into NVIDIA. And it's all going somewhere, right? It's all going somewhere. All right, so my final slide, my favorite slide, is from the other research partner, Athena. And they make all this really complex stuff really simple. Athena said, divided into 4 categories. From the left to the right, behavioral is Athena's patented investment process. They look at how we're behaving. They look at all the investors in the world, all the money moving around the world. And they're saying things are normal to good. That large cap companies are normal. They're not perhaps overpriced, like I spent all that time talking about. And that small cap companies are really good, and international also looks good. And so you'll find, if you look in your portfolios and you have any money with them, that they are in fact, small companies. The second category, the economic categories, and these are the 2 most reliable economic indicators from an academic standpoint. They have the highest statistical validity, and they look at goods, whether we're buying actually things we can touch, or services, which again is the biggest part of our economy, like we talked about. And they're, normally good. Services are caution. They're not growing as quickly as people might like, although recent reports, and this is since October, seem to be showing that turning around. The third category is a caution, and that's that thing that I spent a lot of time on, talking about equity markets being overpriced. And they're showing it at 23, 22.8, 23, whatever it is. That's pretty expensive, which isn't surprising because the market's gone up. And that is comparing it to a long-term average. And like I showed earlier, the past 25 years, the markets have been in a different world than they were the period of time before that. And the last one is the technical indicators, and everything's excellent, positive. So everything looks good from an Athena standpoint. There's, despite all the geopolitics, despite all the news, things look just fine, according to that research partner. So I'm going to come back to a conclusion and bring it back up at the highest level. And today's presentation was perhaps a little shorter than the last presentation. Last time I inundated us with some technical slides and got some really positive feedback from you. If you would like me to go somewhere in between or get more technical, I can do that. But today's slides, I think, were as easy as I could make it to cover really complicated concepts and give you this perspective that right now, if we only looked at that, if we only knew the underlying market and economy, if we only looked at the stock prices, we'd feel good. In fact, we'd feel great because those returns have been fantastic. And they came rallying back from really big declines really quickly, well above average. So if we look back at this someday in the future, we're inclined to forget about how terrified we have been this year. Because what happens is we forget. I was going to put up a picture of not our team. I couldn't get I'm not an AI expert. I was going to put COVID masks on each of us on this picture of the team, right? I was going to show you what we looked like not very many years ago. Have you seen a picture of yourself with a COVID mask on? Go find one. I hope you didn't take one. But if you find one, you might just feel this sense of terror. And that's what I want you to remember right now, because you survived that. And it's going to feel terrifying again real soon. And we won't know why. We'll have no idea why. The president ran and called himself Tariff Man. But the market still freaked out when he talked about tariffs. And they freaked out before he had Liberation Day, which was the most dramatic and, right? It was, and then 6 days later, it was rallying back huge already. We're going to have another terrifying moment. It's going to feel like you felt looking at your best friends in COVID masks and wondering if your love for them is going to kill you because you're too close and we don't know why the news is saying people are dying all around the world. Right? It's going to feel scary to look in your portfolio during periods of time when there's some sort of a financial crisis that is going to portend the end of your economic life. And it's going to happen 45 days or some short period of time, and 5 months later, it's going to be setting new highs, and you're going to forget all about it. And so you're going to go down the road, and you're going to say, I don't even remember that COVID mask until Karl brought it up. What a terrifying thing he did. That was so mean of him. And it is mean. And I do want you to feel that because I care for you, right? I know that we're going to have something crazy happen again. All of the statistics say that when we're going into a world like we're going into, things are going to be more volatile and they're going to end up better than average. And I believe that. And that's all I've got. All I've got is the history to say we're going to have more of what upsets us on our way to getting more of what keeps us safe. So hang in there with us. Talk to your financial planner a lot, as much as possible. Don't call me, between Thanksgiving and December 19th, because we'll talk to the rest of the team. I'll be gone those 3 weeks, but I'll be back, right? And we will still be here, and your portfolios will still be growing over the period of time that matters the most for you, and that's the rest of your life. That's my conclusion for you. So I sincerely appreciate you hanging with me today. All your feedback matters tremendously. I adjust these presentations every time you give me feedback, and I look forward to talking with you again in the future. So, have a beautiful day.